Hey everyone, it's Konrad Bobiak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's market update, April 2025. Can you believe it, how quickly time flies? It's an interesting time in the market, and I haven't done an update for a while because really the Melbourne property market is just going sideways. There's really nothing interesting about it except for the fact that it's about to take off. And that in itself is justifiable why you would watch this whole video, because I'm going to give you my ideas and concepts about when I think the market will take off and when's a good time to buy property. It's always a good time to buy property, as you know, if you've watched me in the past through live events or my YouTube channel. I always say, when's the best time to tell your partner that you love them? Before someone else does. But anyway, I'm going to unpack this whole thing in detail, give you a bit of an understanding about the market, the volume, things that are changing, and where the opportunities are. So grab a coffee, grab a V drink, and enjoy this video. Now, before we get on and unpack the topic in detail, I just want to give you a bit of a disclaimer that everything today is purely for educational purposes only. I'm not here to give you any financial advice. So if you are getting any financial advice, make sure the person that you're dealing with is qualified and has the results that you exactly want to achieve, which is one of the key principles of becoming wealthy. For those who've never listened to me before, my name is Konrad Bobiak. I've got a YouTube channel. I've got a bunch of letters after my name. I've wasted 4 years of my life at Monash University, drinking beer at the tavern and playing pool. I'm a real estate agent, a mortgage broker, ex-banking, ex-financial planning. I used to work for NAB as a financier. The most important thing is that I'm actually a property investor myself. I'm running a real estate agency here in St Kilda, which is my head office, and also I'm a property investor myself with a multi-million-dollar property portfolio. So I'm keeping it real, and I'm actually doing exactly what I'm teaching you guys. And the whole purpose of this YouTube channel is just to give you real knowledge about what's happening in the market from a very practical perspective. And I want to show you where the money is and hopefully save you from making some mistakes and buying properties in areas that underperform. My book has been also featured multiple times as #1 best-selling book on Amazon for various categories. And also my property finance book has also been featured as #1 multiple times in different categories, from mortgages to investments to buying and selling homes. So if you want to get a copy of those, feel free, just jump onto realestateMadeSimple.com.au, or for my finance book, which teaches you how to smash your mortgage in record time, jump onto bookonfinance.com.au. That's enough of my shameless plugs. Also, by the way, if you want to get educated, as a free gift, just being on this video and listening to me, I want to give you access to my online video course, which normally retails for $497. And look, we've sold it for up to $1,000 when it was brand new. It's a few years old now. Not much has changed fundamentally. Micro level, everything's changed because the market keeps evolving. From a macro perspective, big picture stuff like structuring your portfolio, buying properties through trusts, negative gearing, buying properties in the right areas, due diligence and research, cash flow analysis, all those fundamental things, they really haven't changed in the last 10 years. So this online video course is as current today as it was 5 years ago when it was recorded. So definitely all you got to do is scroll down below and access that immediately. There's nothing to buy. There's no upsell. It's just free for you guys to enjoy and expand your horizons. All right, let's get into it. Now, the market is pretty boring at the moment in Melbourne because what really fundamentally has happened is Melbourne has not moved for the last few years because we were and I've done a lot of YouTube videos about why that has happened, but the biggest reason has been because of Dan Andrews' lockdown of Melbourne for the longest period of time out of any major capital city in Australia. Also the introduction of land tax, and also Melbourne was always expensive to start off with. So people have been struggling with just paying bills and putting food on the table, and that's why the market's been going sideways. The interesting thing is that, guys, is that the gap between Melbourne and Sydney now is $500,000. which has only happened once since the last 20 years. And when it did happen, which was back in 2001 and 2 and 3, we had the biggest property boom in Melbourne ever. And I feel like all those ingredients, all those ducks are lining up again, and we're just primed to take off. And Melbourne's going to definitely, it's already taken off past Brisbane. And this is depending on who you listen to for median prices, but definitely Melbourne's always going to be more expensive than Brisbane. And when you're just talking about median price, it's the amount of properties in Melbourne that are over 10, 20, $30 million. I mean, there's some really expensive suburbs in Melbourne. You know, if the median price of $800, $900 million, it doesn't mean much in the context of property investing. There's more millionaires in Melbourne and Sydney than there'll ever be in Brisbane. That's why Brisbane, even though the median price can be comparable, the Brisbane will never have the wealth that Melbourne and Sydney has. It's just not going to happen. But anyway, besides that point, the reality is that Melbourne has suffered dramatically for the last 5 years and has been stagnating. And the introduction of land tax has also smashed the market completely. And a lot of investors, because they buy house and land or old houses in suburbs with a large land component, have been smashed with land tax. And I did a whole YouTube video on this topic. This is why you buy townhouses, not big houses on big blocks. But anyway, that's another topic. Because of that, Melbourne's been stagnating and it's about to shift into first gear now, which is really interesting. Fundamentally, you know, if you look at the real estate market in Australia, it's worth 11.3 trillion. And I keep coming back to this with every property update that I do. I just want to really drive this point home because it's such a fundamental point about that property market. You know, 11.3 trillion dollars worth of real estate value, and the mortgage debt is 2.4 trillion. So if we grab my handy calculator and we work out 2.4 divided by 11.3 times 100, we're looking at a gearing ratio of 21.23. So imagine you have a household with $1 million and you've got a mortgage of 21%, which is 210,000. Are you stressed? Do you think that's a high gearing ratio that these Americans keep talking about in terms of our market? Do you think the market's at risk? Do you think people have borrowed too much money? No, they haven't at all. It's a 21% gearing ratio. And these are facts, guys. There's a lot of information on the internet, and there's a lot of people with a lot of different opinions. But I look at the background and the validity and what are they doing with that information. And a lot of this stuff has just no fundamental basis for anything. It's all just propaganda. It's just hearsay. I'll look at the facts. And the facts are the Australian property market, which is 11.3 trillion, only has a gearing ratio of 21.5%, which is nothing. There's a huge buffer of equity built in. Nearly 80% is equity in our real estate market. And because of capital gain tax exemptions on PPRs, a lot of that equity will never leave the market. People just keep upgrading houses. There is, however, a fundamental shift in wealth in Australia, which is interesting because in the 90s and the 80s more so, if you look at the income distribution and wealth distribution of the average Australian, we had a bell-shaped curve. You know, where majority of the people were kind of in the middle class, and you had a small percentage of rich people and small percentage of poor people. But predominantly in the 80s, there was middle class Australia was the average kind of person, which is why the 80s was so cool. And I was so, I have so much gratitude for growing up in the 80s because it was such a different Australia back then. Compared to what it is now. And they're gone forever. They're never coming back. If you grew up in the 80s, you know what I'm talking about. The greatest decade probably in the last century, in my opinion. But the thing about it is, guys, that at the moment, that bell-shaped curve has shifted into a U-shape. And so what's happening is there's a division of wealth where the rich are getting richer, the poor are getting poorer, and the middle class is disappearing completely. And this is really like interesting because as a phenomena, just from a social context, you can see there's a really big gap between the have and the have-nots. And real estate has a lot to do with it. And getting into real estate and getting your foot in the door is such a fundamental thing of building wealth, not only for yourself, but for future generations, for your kids and the kids' kids. It's going to be impossible eventually for people to get into real estate from a practical perspective, irrespective of whatever the government incentives they're going to create. It's just not going to be a reality for people. So you've got to understand that the market is very stable. Number one, that's my point. There's a very low gearing ratio. Number two is 55.3% of household wealth is locked up in real estate, which is very interesting. If you look at the Australian superannuation pool, it's worth 4.2 trillion. The Australian Stock Exchange, by capitalisation, is 3.2 trillion, and then commercial real estate's 1.3 trillion. So the real estate market, the residential real estate market, is the biggest thing we have in Australia to invest in, and that's why, with all the different banking systems and groups, interest groups, it is virtually impossible for it to fall by any significant amount. Sure, there's short-term fluctuations, but long-term, it is completely, in a way, manipulated never to fall or crash. And I don't believe a crash will ever come in Australia. We just have a huge deficit between population growth and the amount of properties we create per year. So if you look at the last, let's say, these are the latest figures, by the way. Now, with figures, just so you know, we're in April, but we always look backwards. We're looking back at where the market was, because obviously it takes time to capture data and analyze it. So, this is pretty much March quarter data, which is pretty accurate, for the 3 months. And this is for combined average capital. This is for all the cities in Australia combined at the national level. The market grew at 0.7%. After falling for 3 consecutive months, the rolling quarterly average went up by 0.7%. Then for 12 months, 3.4%, which is huge. There's a huge disparity, however, between houses and apartments. Houses values up 0.5% and unit values up 0.3 over 3 months. The premium for houses increased to 31.5% in March, expanding from a recent low of 25.8 in January 23. So we have a preference here in Australia for detached houses and townhouses over apartments, because you don't own the land with an apartment. The strata pretty much owns the land. You just, you have an apartment in the air. But also from a practical perspective, we like backyards. We don't want the privacy, the security of a dwelling. We can drive into your garage and walk into your kitchen without interacting with neighbours in any way, shape or form. So Australia is always going to have a preference for townhouses and detached houses. That's why I only sell detached houses and townhouses. I don't sell apartments. I'm not a big fan of them. I think there's a place for them. They're here to stay. And I think as a functional thing, they provide a solution for people to live in. And especially a lot of suburbs in Melbourne, like Toorak and Brighton and Hawthorn, most people will never buy a house in those suburbs because you need $2 million, $3 million for an entry-level property. So apartments are the only thing they can actually do if they want to live in that specific suburb. So I'm not banging apartments from a practical perspective, but from a investment perspective, there's an opportunity cost to everything, and apartments just don't have good value for money, in my opinion. If you look at the 3 months dwelling average changes for Melbourne, 0.3%. So we came from a negative, and we're just going slightly up, going back to a neutral position. 12 months the same. So we've just, in terms of Melbourne's negative 2%, and now it's positive. So it was negative, and it's coming into a positive territory, which is fantastic. And the major capital cities are all over the place. I'm going to unpack them individually. The most important thing to understand that Melbourne is about to go into a super cycle boom, and one of the biggest indicators of that is that the 75th percentile, which is the most expensive properties, are starting now to move up. So if you look at this bar here, this is the 75th percentile, which is the top 25 most expensive, in terms of percentages, most expensive houses in Melbourne. They went up 0.3%, where they were negative for the last 5 years. So the rich people are starting to put their mansions on the market, which is a really good sign. And that's always the beginning of every property cycle in Melbourne, Sydney and Brisbane, is the rich go first, then the middle class, and then the worst suburbs get dragged up because of fundamentals. Now, sometimes there are key suburbs, infill suburbs or subdivisions that are prime, that independently just take off because of supply and demand. But overall, this is a principle that gives you a really good indicator the market's about to move and shift into another direction. In terms of housing cycles, you can see there the rolling 28-day average from CoreLogic tells you that Melbourne has grown 0.5%, which is great. You average that out over 12 months, you've got about 6% growth. Adelaide 0.7, Brisbane 0.3, Perth 0.2, and Sydney 0.1. Sydney is definitely slowing down now. Perth is also going backwards, and Brisbane, and and now it's Melbourne's time to take off basically. So Sydney now is slowing down. You can see there 0.3% for the March quarter. For the last quarter, also for 12 months, increased by 0.9%. So we saw some massive growth there, and now it's kind of coming to an end. If you look at Melbourne, we're in negative territory after a slow little bit of a peak there back in 24, but we were marginally going sideways last year, and then we've just turned the corner and we're just about to go up again. Now we could have a little kind of a W bump and then go up again. But definitely we're going into a super cycle. We're going to see, 10, 15, 20% growth in Melbourne very shortly. We just need 3 or 4 or 5 consecutive rate cuts. And I've done another YouTube video just on that, which will be coming out very shortly, on the banks in Australia about to cut rates. But definitely Melbourne is about to go into the growth phase of the property cycle. Brisbane's in a decline. Same with Adelaide, same with Perth, Hobart's going sideways. Hobart's kind of reach its potential in terms of price point, and there's a very small economy in Tassie. So the people's borrowing capacity is very restrictive compared to Melbourne, Sydney, and Brisbane, for example. So there's only so much that Hobart can do. And Hobart's done really amazing stuff for Hobart. I mean, it's a great city. I'll definitely live there, no problems. It's a fantastic area. Darwin's going sideways now. There's a lot of uncertainty with the commodity sector and Australian dollar and tariffs. Canberra as well, sideways movement. In terms of sales and listings, this is kind of interesting because the volume of listings is very much linked to consumer sentiment and how they perceive the market. And we've had a very low volume of listings in Melbourne. In fact, in the last 5 years, some suburbs in the Bayside and the eastern suburbs where I source were down 30 to 40% of the normal volume of listings they should have in the last decade. So people just weren't selling properties, they weren't upgrading, they were just holding back. It wasn't a priority for them. They were just trying to survive and get through COVID and get through land tax and get through all the escalations, the 13 increases in interest rates, and all the escalations in housing costs and living costs and energy prices going up and insurance and everything else. So people weren't kind of thinking about, we've got to upgrade our house because we want a, 5th bedroom or a swimming pool or a bigger, more car space. They were just trying to hold on to what they have. And I'm really generalizing here. And that's really what happened. Despite the 1 million people that came in, that was kind of a holding pattern that we've had. And you can see that it's a kind of a sideways movement. And now it's about to go into a growth phase because that 1 million people that came in, they've all secured their jobs. And just to understand, Labor has let in 1 million people. And their argument is, well, during COVID, it was locked down, so it's still the average is still kind of the norm. It's not. The thing is, if you're a migrant and you're coming into the country, and by the way, I'm a migrant from Poland, so I'm all for migration. I just don't think we should have 1 million people coming in at once without any solutions for where they live and what they do, because ultimately everyone will be paying for it in terms of roads, congestion, hospitals, not being accessible, childcare facilities. We need to grow the infrastructure and then bring the people in. But I definitely love the fact that Australia is the biggest, multicultural society in the world that is functioning relatively well. So there's nothing wrong with migrants. So don't email me. I'm a migrant. But what I'm saying is bring them in, but build the infrastructure so they have an easy way to get around. But now, going back to finance, once you get a job, you can't really borrow money and buy a house immediately. What happens is usually you need 12 months tax returns. Usually most lenders want 2 years. But just from a practical perspective, like if you're coming in, let's say you're a migrant from China, you probably get a place somewhere to live in the city or somewhere central to your work. But then it takes about 12, 24 months to get your head around the suburbs in Melbourne. Well, most people won't buy a house within 1 month of arriving in Australia, unless they've been here before, they have family and they're giving clear instructions of what to do. Most people would want to kind of live here and get a feel for the area and work out where the suburbs are and the dynamics and the demographics of the suburbs. So really, this is why it will take a number of years before that 1 million people start buying houses. And on top of that, we've had nearly 7,000 building and construction companies go bust in the last 5 years, which is unprecedented, under the Labor government predominantly, and due to lockdowns. And some of the biggest builders in Australia have gone into liquidation. So we haven't got the industry, the building industry, that is required to build these houses. And under Labor, they've built no houses under any investment scheme or any scheme they had in the last 3 years. So they were supposed to build 250,000 homes by now, but they've built zero, which means that, they're incapable of doing it because they need the private sector to really build them. So really what's happening in the market is the volume is slowly increasing in Melbourne, but it's early days. Median prices on the market. So this is the amount of days that it takes to sell a property. So in Melbourne, for example, in March 25th, it takes 47 days to sell a house. And then in March 24, it was 38. So it's taking a little bit longer to sell houses. The sentiment's still not there, but the volume is increasing, and that volume isn't being absorbed as quickly as we wanted. But that also is slowing down. I mean, 38 is a pretty healthy market. So it's vendor discounting is pretty low in Melbourne, negative 3.4 for this year, negative 3 for the previous. So people are slightly discounting properties. You'll find that most of the vendor discounting is in the fringe suburbs. It's not in premium suburbs. In premium suburbs, people are not discounting as much as they could because they have the option whether to settle the property or sell the property or not to sell the property. By the way, the market only operates 10 months of the year, so the volume of listings is slightly increasing, which is a good sign. You just got to take December and January out of this kind of chart. One thing that I like about data is it doesn't give you the whole picture, but it gives you kind of clues to what's happening if you know how to read it properly. And if you look at them, for example, combined capital cities, so new listings nationally remain below the previous 5-year average compared to last year. Most capital cities have an increase in fresh advertised properties, advertised supply. Brisbane and Hobart were the exceptions because they've hit their peak already, with new listings in Brisbane impacted by the aftermath of Cyclone Alfred, when Hobart listings tend to be weaker amid accumulation of total advertised stock in 23 and 24. But the thing about it is that in Melbourne, we have a very fragmented market. So we haven't got one common market in Melbourne. There's 8 distinctive markets, and they all almost have different property cycles within themselves, because you can have an auction clearing rate in one market for 50%, 55%, another market 60, 70%, another market 90%. But Melbourne is increasing in terms of the volume, 8.3%, which is pretty cool. That's a pretty healthy increase in volume compared to the size, given the size of Melbourne, but it's still not there. Like, for example, Canberra's 28.5. It's still not there to the level that you wanted to see before it starts going into the crazy boom phase. Auction clear rates. Well, this is the thing about auction clear rates. It's Melbourne. How do you measure it? Because there's so many different markets in Melbourne. It's hovering around the 65 to 70% mark. But really, you got to look at suburb by suburb specific auction clear rates. I mean, to me, a good auction clear rate is 75%. 7.5 out of 10 houses sell, 2.5 get passed in. If you're buying secondhand, you want to buy those passed in properties because that's when the agent works for you, not the vendor. Remember, the real estate agents, traditional real estate agents, not myself, who I'm a property sourcing specialist. I don't deal with mum and dad owner-occupied properties. I just source and sell investment properties to investors. But normal real estate agents work for themselves, number one, for the buyer, number two, for the vendor, number three. They don't work for the vendor, despite what they want you to think. They couldn't give a shit about the vendor. All they care about is their M3 or their S4 or their C63 AMG Mercedes-Benz doesn't get repossessed next month. They want commissions. That's what they want. They don't care about the property or how much they sell it for. They want the sale, and they'll do everything they can. And that's why the best time to buy property in any market is on Monday morning, after the property's been passed in at auction on the weekend, because then you can then work out, why is the vendor selling and how much are they willing to go down to part with the property. And the agent will start working for you and crunch the vendor and get you the best price. But once again, it's very fragmented. Like as I said, 75 is pretty. That's a good market. It's a strong market. Once you get to the 80s and 90s, it becomes a bit crazy. Like when you get 8 to 9 properties out of 10 selling, there's pretty much you can't negotiate anything. You can't do anything. At the same time, when you're getting 5 out of 10 selling and 5 getting past 10, that's a depressed market as well. And I saw that during the GFC in 2008 when auction clearance rates went down to 47% in Melbourne. So less than 5 houses out of 10 were selling. The rest were getting past 10. Now, you could argue that's a really good time to make up, give lowball offers, which is a really good strategy. You just got to have the financials and the know-how during that depressed market to do so, because it's easier said than done. A lot of people wait for market timing, but you've got to have a lot of discipline and knowledge to do that. Well, the rental market now is going back to its normal rental yields of 3.5%, 4% for Melbourne, Sydney, and Brisbane. Mind you, if you bought back in 2020 and 2021, you would have gone up. Your rent would have gone up in Melbourne in the premium suburbs by 60% in those 5 years. Some of the suburbs actually have gone even higher. It's been crazy, and I've seen up to 30% increases, in 12 months on rental. So rentals went from 800 to 1100 per week in 1 year, which is crazy. At the moment, it's tracking just at inflation, which is fine. It's healthy, and it is what it is. Remember, rental cycles always follow capital growth cycles, and they stagnate behind them 2 or 3 years. So you can never get anything where, and this is one of the traps investors fall into. I see this all the time. I say investors come to me and say, I want a property that has high growth, high rental yield. Well, if you bought it 5 years ago, you would have had high growth if it's the right suburb, and the rental yield will be 6.5%, 7%. But you can't buy it at the time with that rental yield. Because the rental yield and capital growth have an inverse relationship between each other. The higher the capital growth, the lower the rental yield. So, for example, let me just throw some figures at you, just simple figures. Let's say you got a property for 500,000 and you're getting a 5% rental yield, right? You're getting 25 grand a year. If that property goes up to $1 million, your rental is still 25,000, but now it's 2.5%. So there's an inverse relation between capital growth and rental yields, right? And the gap is around 2 or 3 years, even 4 years, depending on the suburbs and the income demographics. So don't chase rental yields in Melbourne or Sydney. Chase the fundamentals of the property. And what I mean by that is target areas that are affluent, close to city, close to water, with the highest income earners you can afford to buy into, and the rent will look after itself. It'll be cash flow positive within 5, 6, 7, 8, 9, 10 years, depending on how well you've purchased and what the property is. But don't chase rental yields, okay? Chase capital growth, and then the rental yield will come if you've done the right research. And this is the thing, and time is always on your side, right? So you can never have in Melbourne a situation where you're getting 10% capital growth, 7% rental yield. It just doesn't exist on blue chip properties. You might get it with Airbnb or holiday lets, or some student accommodation, but not on normal properties in the open market. But it will happen if you hold on to the property for 3 or 4 years or 5, depending on how well you've purchased. So that's a very important point, because people get so locked up with this rental yield thing. And I get it. It's cash flow analysis. I get it, but it's not where the money is. So once again, the rental yields, Australia 3.7, combined capitals 4.4, and combined capitals 3.5. Yes, it's been a nightmare for tenants in Melbourne. People are getting priced out of the rental market completely. And if Labor and the Greens form a government and they roll back negative gearing or start tempering with any taxes, and investors start dumping properties, you've got to understand one thing, guys, because people don't think about this. If you've got 10 properties owned by investors, and let's say they change the tax code or make alterations or amendments to make it less attractive for that money to stay in those 10 properties, whatever reason, right? When those properties, if those investors independently decide to sell those properties in the open market, remember, investors only make up 20% of the market. So the other 8 properties will become owner occupied. So what you've done is you've shrunken a rental market of 10 properties down to 2, because the other 8 was sold. So you got the greedy investors out of the market, right? But they weren't sold to other investors. They were sold to people to move into, mums and dads, owner occupiers. So what tempering with negative gearing does, already kind of tempering with any tax outcome that is negative, that is a disincentive for investors to buy properties, ends up shrinking the rental market even further. And economics 101, supply and demand, if you have a limited something and huge demand, prices go up. And this is what's been happening in Melbourne and Sydney. In Melbourne, people have dumped a lot of properties because of land tax. I know a lot of people that have sold houses that where the land was virtually the whole value of the property. They had a 1950s build. The land was, $2 million, and they're paying something from their land tax went from 1,300 to 7,000. And so they sold them, but they sold them and people bought them. Developers bought them to redevelop, people moved into those properties. They didn't create any solution for the rental market. And this is what Labor and the Greens don't understand. It will have an adverse effect. Anything they do with the investment market where investors start dumping properties will just shrink the rental market. And ultimately, you need a rental market because most people that end up owner-occupiers at one stage or another, whether it's at university or whether it's the first job, they want to rent a property. And this is what investors like myself create. We're market creators, market makers for people to live in properties while they're getting their deposits together, while they're getting financially ready, or while they just don't choose to rent invest, which is a new trend. A lot of young people don't want to live in, Pakenham, they want to live in South Yarra. So they rent in South Yarra and they invest where they can afford to invest, and they live where they choose to live. So this is the thing you got to consider always. If you're a Labor supporter or a Green supporter, you got to understand this always happens. And there's been countless examples around the world. Ireland is the biggest example, where they created such negative changes to the tax system that all the investors dumped their properties. And at one stage, there was less than 100 properties in the whole country to rent. Because the money is going to go somewhere. It's going to go overseas to another market, or the stock market, So dwelling approvals, they were down. You can see the decade average. They're just kind of going sideways. They're waiting for directions in the market. And with the recent announcements by the RBA, if you read between the lines, and also the banks, there's going to be massive rate cuts, which is another YouTube video that I'm doing, which will come out very shortly. And I think once the market gets a direction, they're going to take a directional stand on the property market, which means more people will start borrowing money because funding will become cheaper. NAB says there's going to be 5 cuts, and the bank swap rate will go down to, 3.1%, 2.89. So it's going to be super cheap. And so there's going to be more investment approvals, more dwelling approvals, more development approvals. Currently, we've had a low, and it's just recovering now slowly on the back of sentiment, but it's still nowhere near where we were back in 20 and 21. So investor lending is still record low based on the 10-year average, and it's still below the national average over the last 10 years. You can see there by the red bar in the bottom. So the market's waiting for a direction, and it's going to get it. It's already, I think this year we're definitely going to get some direction at the end of the year with interest rates. They're definitely going to go down. And there's going to be a massive impact on property ownership and obviously the ability to borrow money. First home buyers, absolutely. Everyone's throwing money at first home buyers whenever there's an election around, which is just easy votes, and people will make up their mind which way to go. That's going to create a short-term impact on the market. Usually, these incentives just boost the market. They have the adverse intended impact on the market, especially by Labor. So whatever they cook up, it always bites them in the ass, and the market does the reverse. The interesting thing is interest rates, guys, because interest rates and money really is what drives the market to a large extent. The ability to secure funding and your ability to create a scenario we can hold on to investment properties and pay for the shortfall. And that is going to be the topic of my next YouTube video. And I'm going to show you where the market's heading. But it's definitely heading in the right direction. I think everything is very positive. There is a light at the end of the tunnel. We're not out of it yet. It is still going sideways. It's a good time now to consolidate yourself, get your tax returns done, make sure your pay slips, your personal debts are looked after, maybe rolling over some personal debts into long-term debts to increase your serviceability. This is the time to prepare and get market ready. Remember, the definition of success is when preparation meets opportunity, and you've got to prepare before you become successful. So we're about to go into a growth phase, guys, and this is very exciting time in the market. Where in the national property cycle? Well, the market is very cyclical. It goes up, down, bottom, and recovery. According to Harrington White Valuers, this is a March 25. Melbourne is in a declining market, and you'll find that because with valuations, it's even the cycle of the data is even longer than just selling properties. You'll find that we're already kind of at the bottom of the market, going into a state of recovery. But it's definitely going in the right direction. Yes, it's always the best time to buy at the bottom. If you ask me when's the best time to buy, always number two. I don't know, probably around 8 o'clock when the market's about to go into a growth phase. And this is kind of what I look for. When we're looking at the behavior patterns of successful people, and I'm a big believer that if you find a bunch of successful people in any industry, it doesn't need to be property, it can be the stock market, can be Amazon drop shipping, can be cryptocurrency trading, whatever it is, options, futures. If you find a bunch of successful people that are making money and they've never met each other, yet the behavior patterns are the same, there must be something to them, right? You can't have coincidental behavior patterns just happening, for no apparent reason. There must be successive clues. And so what people tend to do is counter-cyclical investing. A lot of investors take advantage of depressed markets because the fundamentals don't change. Elwood's always going to be a great suburb to invest in Melbourne. For Melbourne, Albert Park, Middle Park is always going to be great. And Point Cook, Trigonina, Tarneet's always going to be bad. Nothing will ever change. It is what it is. Just the same reason why Camry would never be a Mercedes. And no matter what you do and how you package it up, it's just the reality of life. And so what do you do at different parts of the property clock? Well, at 3 o'clock, you can either do nothing and just consolidate your resources and get market ready if you're starting out. If you're a seasoned property investor, they've got clients now that are buying the 7th, 8th, 9th, 10th property. They're buying hard, and they were buying last year as well when the market was even worse. Because to them, short-term market timing is irrelevant. They're looking for long-term value, and because they've got 5, 6, 7 properties, they understand how to do due diligence and research, and they've got a goal of getting, let's say, 10 or 12. If you're getting your first property, probably you want to get in as soon as you can, but I'm saying where do you spend the majority of your time is getting market ready. And sometimes if you're on a low income and we know we're going to get multiple rate cuts, sometimes it's better to stay out of the market until you can get the really good property than just to jump in and get something for the sake of buying it. Because it's all about quality, not quantity, guys. At the bottom at 6 o'clock, you have an increase in rentals. We're going to have a big jump in rentals as well. And then the best time to buy from a timing perspective, if you have to, is from 8 o'clock, 9 o'clock. And then when you market goes boom from 9 to 12, which is that critical part of the clock where everything's booming, that's when you want to refinance your properties, lock in your lines of credit in order to buy at the bottom of the market. So this is kind of the behavior pattern of the most successful investors that I've been hanging around with. This is exactly what I do myself personally as well. Yes, it's always beautiful to buy at the bottom, but what if you get to the bottom and you can't borrow money or there's nothing good to buy? And this is what happens all the time. I see people timing the market and they get there and it's like, oh, there's nothing to buy, or I can't afford to buy anything because interest rates are too high. So my, I know I sound like a broken record, guys. It's not time of the market that matters. It's timing the market that matters, not timing of the market. And remember, we're heading for an impending property boom. 20 years from now, the average homes in Australia may cost up to $6.3 million. In 20 years, bombshell study has revealed. Projections show median house prices will reach their figure in Sydney by 2043, up from $1,030,000 today. It's actually now $1,300,000. The Aussie Home Loans CoreLogic survey predicts the average price will hit 5.8 million in Melbourne, that's the median price, 2.9 million in Canberra, 2.5 in Perth, 2.3 in Brisbane, and the biggest increase in Melbourne. Melbourne will go up to 5.8 million, and it could even go higher by 2043. If we keep allowing all these people to come into the country, it's definitely going to happen. If the Liberals come in and they slow down migration, it might slightly underperform and go to 4.5 or 4 million. But it's still going to have massive capital growth. And this is what's happening right now. So from a timing perspective, from a time perspective in the market, the sooner you get in, because eventually, no matter how low the interest rates will be, even at 2.5%, 3%, you won't be able to buy anything because there's a massive variance between income going up and capital growth. It's completely out of orbit. It's like a planet that's out of sync with the orbit of the other planets. And capital growth is out of control in Australia as a fundamental thing. And wages will never catch up to capital growth as a function. And that's why the rich are getting richer, the poor are getting poorer, and the middle class is shrinking so much. Because even the middle class now is finding it hard to get into the market. So my recommendation is do whatever you can to get in, get as much education, network, do whatever you can. Be fearful when others are greedy, be greedy when others are fearful. Think about it, guys, 6.3 million in 20 years. And remember, this is the market since 1880. And you can see that after World War II, it was purely grown based on migration. You could have bought a property in Glen Waverley. Houses were selling blocks of land when it was a subdivision at one stage, $5,000, $200 deposit. A nice house in Glen Waverley in the 60s would have cost you £3,375 to build. And that's what they were building there in Glen Waverley. Crazy. Now, yes, there was short-term volatility, but long-term, if you hold that property from 1960s to today, think about how many times you multiplied by. Now, if you're interested in learning more, I am running a limited amount of time. I'm only doing a couple more this year because I'm just so busy with my existing clients. And I'm also going to do more stuff online just because the whole industry is going that way. But I love doing live events. I'm doing one in Melbourne that's coming up. You can just go to realestateFastTrack.com.au. I've actually now just revamped all my PowerPoint slides, and I've listened to a lot of emails, and I'm putting more case studies, and I'm putting more cash flow analysis, and I'm spending more time on the micro level stuff rather than psychology and the big picture stuff. So there's going to be a lot of case studies of clients getting, how do they buy 3, 4, 5 properties, really micro level details, because I've did a number of surveys for the last 10 live events that I've had. A majority of people wanted to learn micro level stuff over macro level stuff. And I hear, and that's what I definitely want to deliver. So the next event will be very different from the others. And I'm going to cover that extensively. Tickets are $47, plus you get a hard copy of my book, Real Estate Investing Made Simple. We include lunch, 2 days of networking. It's an amazing event. If you want to check out a digital version of the event that was recorded about 5 years ago, just scroll down below for accessing the online video course. By the way, it's very different now in terms of contents. This is still very relevant, by all means. Like I mentioned before, it's 80% current, 20% things have changed, micro level. But the new event that I'm creating now will be very different from the old events. So if you want to attend that, I definitely encourage you to do so. Also, some of you will be interested in working with me personally one-on-one. If you need help in setting up your property portfolio, if you want help sourcing properties in Melbourne's highest capital growth suburbs, that's all I do for my clients. So you're welcome to book in a 60-minute strategy session with myself personally on Zoom, and I can do a whole plan. I can take an idea to a plan and create an action plan. You walk away with a real kind of step-by-step system of what to do exactly, what to buy, for how much, cash analysis reports, everything. So what I do is I look at where you are currently financially, where you want to be, and I give you a real plan from step-by-step of what to do. Remember, if you fail to plan, you plan to fail. A lot of people waste so much time and energy going from A to B, and it looks like this. If you get the right assistance and the right person, the right team behind you, you can just smash it very quickly. And we've seen clients buy 2, 3 properties in the first 12 months of working with me. So there's no limit. We will go as fast as you want to go. I mean, there's definitely no shortage of properties. I have access to up to 1,700 properties at any one time. So it's an hour strategy session with myself. It's free. There's no strings attached, nothing to buy, nothing to pay. I go through where you are, where you want to be. But this is only for people who are interested in building wealth through brand new houses and townhouses in Melbourne. I don't do subdivisions. I don't do apartments. I don't do house and land in the middle of nowhere. These are blue chip areas, blue chip suburbs. So it's only townhouses and detached houses. So if building wealth through blue chip properties resonates with you, I encourage you to book in a 1-hour strategy session with myself, and you walk away with a very clear understanding of exactly what's relevant to you, what you can buy, how much you can borrow, and I'll show you how to bridge the gap between where you are and where you want to be financially. I'll also give you an introduction to my whole team, my mortgage broker, my accountant, my property solicitor, conveyancer, quantity surveyor, insurance broker, property management, financial planning, the whole thing. So you walk away with a whole team, and I've used these people myself for my wealth, and definitely a lot of my clients use them. You don't need to use them, but you're welcome to use it. They're all independent companies, been around for a long time. For example, Cameron Fisher from Changing Places Real Estate, 47 years in real estate sales and management. Stephen McClutchy runs Loans Australia, $1 billion in settlements himself, 30 years lending. James Black from Brainy & Co. Accounting. He talks about buying properties in trusts versus personal names, self-managed super funds, and how that's relevant to property investing. So you walk away with a real strategy, step-by-step kind of a blueprint for building wealth through property investing. Now you have to qualify to get these sessions. Number one is the cheapest properties that I sourced that match my criteria are kind of 700,000. The average is 1.2 million, 1.4, which is like a normal townhouse in Melbourne. So to be able to afford to buy property, you'll need to have at least $95,000 income as if you're a single person with 112,000 in equity or cash, available equity in the property or savings. If you're less than that, don't book in. I won't be able to help you. I don't have any properties at 500,000. If you're unsure, go to a bank, get a pre-approval. You can borrow 700 at least, ideally 800 plus. Then come and see me definitely. If you're a couple, you need to be on that 140 combined income, 112,000 in equity or cash. If you're wealthy, if you've got stronger income than that, if you're on 250 grand, the average client of mine is on 200, 250, and they've got $1 million in equity, and they're looking to buy blue chip properties in blue chip areas. If that resonates with you, definitely, all you got to do is email me directly, Konrad@investorsprime.com.au, and I'll just book in a mutually convenient time to catch up on Zoom, and we can go through your situation. That's it for me, guys. I hope you enjoyed that update, and wish you all the best with property investing. This is Konrad Bobiak. I'll see you on the inside.